We've got Santosh Navlani, who's the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time, and good evening to you. I want to start with a question about hybrid funds in general. Now, this is a category of the mutual fund industry where you have a couple of mutual fund schemes that are very well known. Balanced advantage funds, dynamic asset allocation funds, they've been marketed well and therefore people know about them. The category, or rather this particular scheme, assets under management have grown quite substantially. Would you say that people are familiar with how they work?
Yeah, Alex. I think these two categories are, I would say that they are mainstay retail investor categories a lot more than other category of hybrid funds. And because they've been possibly there for a long time, a lot of people are aware about it. They also tend to give pretty decent returns vis-a-vis equity funds, and hence their appeal seems to be more in the retail investor segment. Hence, I think the probability is rightly pretty high compared to other set of hybrid funds in the market today.
But the scope of today's conversation, I think, is beyond those two, because there are a few interesting concepts beyond balanced advantage funds, dynamic asset allocation funds as well, that we can focus on, and a number of them, right? You talk about conservative hybrid fund, you talk about balanced hybrid, aggressive hybrid, equity savings. Let's go into them one by one. Let's start with the conservative hybrid fund. What is the scope or the purpose of this fund, and who should go for it? What should they bear in mind?
Sure. Yeah, so Alex, before I just answer that question, I think what we need to understand to be able to grasp the space of hybrid funds, it's very important to understand the what exactly these categories are. So it basically means that instead of having a full equity fund portfolio or a full debt fund portfolio, the investor have an option to mix both these primary asset class into one fund, and that's where the hybrid category comes into picture. Now, depending on the equity and debt levels, the minimum debt which is supposed to be there, the maximum equity which is supposed to be there, or the freedom to the fund manager which is available for going anywhere into equity or anywhere into debt, is what constitute different kind of subcategories into hybrid funds. So once we know that, ultimately is the mix and match combination of equity and debt rules or allocation rules, that's where you basically are able to see so many categories or subcategories in the hybrid. So the first one, conservative hybrid fund, I would believe it's probably one of the lowest risk category amongst hybrid funds, where you typically don't end up having equity allocation beyond 25%, and rest of the money goes into debt. So the typical definition as per SEBI regulation is a conservative hybrid fund is a fund which has 10 to 25% allocation to equities, rest being in debt. So if the fund manager is basically only about 15% in equity, the 85 will be going into debt. If he is 25% in equity, which is the max allowed limit, then 75 will be going towards debt. So, but ultimately, it's suitable for a customer or for an investor who is actually very clear that he wants some kind of equity kicker into the portfolio, but primarily a debt investment is what he's looking to invest in. That's where conservative hybrid can basically come in and give you that small kicker in terms of returns from equity, but give you primarily debt kind of returns. So these kind of funds actually tend to give debt plus kind of return, is in the long run is how I put it, or FD plus kind of return is how I put it, and they're possibly far less risky compared to equity funds that we are aware of.
Interesting. And you've also detailed the performance of some of these funds over the course of the last 5 years. I'm just trying to understand from the perspective of which investor or which goal would you use this for? I would think that because you have a bit of a kicker for equity, you're thinking that this is something that will serve a relatively longer term goal than a pure debt strategy. And this is something that you would look to take advantage of the debt taxation rules for debt mutual funds. So how would you say an investor should utilize this?
So by definition, when there is an equity component coming into the portfolio, which can go up to 25%, it's very kind of simple math to follow, that one should not be investing in these kind of funds if one's horizon is less than 2 to 3 years at the minimum. And when you are basically investing in a fund which is minimum suitable for 2 to 3 years or more, then you always get the advantage of debt taxation, which is basically you get the advantage of indexation benefit, which means that your cost of purchase of the units is increased by the inflation every year, and only the kind of gain above the inflated cost is taxed at 20%. So of course this is something which you should be investing for 3+ years kind of zone, and that's where you get benefit of taxation as well. And ultimately, if you look at any kind of conservative hybrid fund and corresponding FD returns for those 3 years, you would possibly see that the advantage because of taxation benefit is far higher in conservative hybrid funds, even if it is slight volatility coming into the picture. And these funds can be actually used for short-term goals that most of us have. Can be kind of investing towards buying a kind of vehicle that we plan to do for a few years from now, maybe a four-wheeler, maybe a two-wheeler. Maybe people also look at these funds as something which they would want to just hold on as savings, which are largely in safe zone. And I think most people have that thing that once their emergency fund is taken care of, long-term investments are taken care of, you would always want to have a cushion which you can fall off for something which can be kind of look to flow for some kind of unplanned expenditure, which in a happy day kind of scenario, or for that matter something which I can just look to for my asset allocation perspective, that I am having a primary debt portfolio. So these are good funds when you are having an horizon of, I would say, 3+ years, and they reward you well because of the equity component coming in picture.
Let's talk about the next category, which is balanced funds, not to be confused with balanced advantage funds. What's the difference here, Santosh?
Yeah, so balanced funds, again, as I mentioned in the beginning, Alex, all hybrid funds basically are same, just are similar in construct, just that the level of equity and debt, which is allowed under SEBI's regulation, constitutes a new kind of category. So when you look at balanced funds, the definition of SEBI tells us that the equity component can vary from 40 to 60, and the remaining has to be in debt. So if the if equity component is 50, then you will possibly have 50% in debt. If your equity component is 60, then 40 will be in debt. The good part is the fund manager here gets chance to kind of maneuver between 40 to 60 as a dynamic range for equity. So where you know that as an investor, if you are somebody who's slightly more moderately aggressive person looking to invest for kind of 3 to 5 year period in a favorable market when at the time of entry, you know that I would want to invest something which is beyond debt, but I want to limit my exposure to 60 in equity. But at the same point of time, I don't want such a low risk product where my equity allocation is around 10 to 25%. So that's where balanced fund comes and fills a gap. These funds, slightly higher risky than conservative hybrid fund, are suitable are suitable for the same advantage of tax, again, because these have tax benefit of debt taxation. So again, when you invest for 3+ years, you'll get that advantage here. And the modus operandi, or the way the fund manager manages debt portion, is very, very similar here. People look for accruals. The kind of papers which are there in debt are typically short to medium term tenure, low credit risk, and where interest rate sensitivity is not typically higher. So these are funds, again, which are slightly above on the risk parameter from conservative hybrid, but nevertheless, a good category which possibly has not seen enough traction, in my opinion.
But if you were to compare this with balanced advantage funds, which I guess would be the appropriate thing to do here, how would they differ, and which would you pick between the two? Because I guess they would serve similar goals or similar objectives.
Yeah, so in the long run, Alex, I think the returns of any kind of balanced product tends towards equity. I would not say tend towards equity, then they go and match towards equity, but they always fall between debt and equity returns in the long run. So if you look at long-term performance, they may be similar, But I think the kind of investor and the purpose who invests in balanced advantage will be different than who invests in balanced funds. So balanced advantage have far larger appeal, far larger use case, or far larger, opportune times to invest than balanced funds, simply because they are much more dynamic in nature than this 40 to 60 tight bucket. So fund manager in balanced advantage is allowed to basically go as low as 10 in equity and as high as 100 in equity. Though the different set of balanced advantage fund in the marketplace available have different their own guiding principles. Like one of the largest fund in the category, which is IC's Balanced Advantage funds, or one of the better funds in the marketplace, Edelweiss Balanced Advantage funds. Both these funds have minimum allocations of equity as 30, and they try to give you equity taxation benefit by putting the balance which they need to reach towards 65 in arbitrage opportunities. So if you look at the difference between minimum equity component of balanced advantage and minimum equity component of balanced fund is not very different. They can go as low as 30, and while a balanced fund has to stop at 40. But on the higher side, the balanced advantage funds can go up to like 80, 90, 100 in equity in some cases, where it can tend to be risky for you if you are a conservative investor or a moderate investor, whereas balanced fund allows you to be 60. So if you're somebody who's long-term investor, even if you're a moderate profile, I think balanced advantage funds will serve you better, because if you look at long-term equity holdings of these funds, it will always tend towards minimum being around 30, 35, 40, and on the higher side towards 60, 70. So the risk metric of these funds is very similar to balanced funds, but because of the dynamic rebalancing, the dynamic approach to management, the returns tend to be better. And of course, you have the advantage of equity taxation if you wish to invest for less than 3 years, which I would not recommend, but some people may look at opportune market time and get into these kind of funds to take advantage.
I would suppose the flexibility and nimbleness of the balanced advantage fund, because of the arbitrage opportunities, is something that bodes well for it, right? Let's talk about equity savings funds as well. What are the key metrics to watch here?
So equity savings fund actually are almost like a sibling of conservative hybrid is how I put it, Alex. So one of the simpler ways to look at equity savings fund is when you have horizon less than 3 years and you want a conservative equity product where you want to limit your equity allocation to like a 25, 30, 35% at max, equity savings fund are better suited to you. And when you are looking to more than 3 years, then conservative hybrid comes in. Otherwise, the long-term performance of conservative hybrid and equity savings, or the risk return metric, is actually quite similar. They differ in taxation and how they operate. So taxation is we covered, but how they operate, equity savings fund, the SEBI definition is you have to have minimum 65 in equity and equity related instruments and minimum 10 in debt. So the modus operandi in the marketplace is such that most funds will actually limit your equity allocation towards 30, 35%. They would use the equity definition in the form of arbitrage. They put the rest of the money in arbitrage so that it always have minimum 65 in equity from a taxation standpoint, and rest will typically go in debt. So what happens between conservative and equity savings fund, if you notice, the conservative hybrid fund minimum always be about 75 debt. So debt keeps making money typically all the time, all the day, because of the interest accruals that you will keep coming in. But what happens in equity savings fund, because of arbitrage opportunities, arbitrage doesn't make money on a daily basis. And the long-term returns of arbitrage is very similar to liquid funds, which is less than debt. So what happens is in the long run, you would see the conservative hybrid funds tend to outperform equity savings fund. In the short term, the equity savings fund may or may not outperform, or conservative hybrid fund may be a different kind of better off. So you need to look at that. If you're a long-term investor, stick to conservative hybrid fund, and if you're a short term, like looking to be opportunistic about market entry and not want to commit beyond 3 years and be open to get out within 2 to 3 years, then equity savings fund will serve you better.
There's one more category that we should talk about, which is aggressive hybrid funds. I guess, as the name suggests, this would entail a higher amount of allocation towards equity. But let's run through the key objectives and how this fund functions.
So, is a kind of last category of fund in the hybrid on the risk spectrum is how I'd put it. So, if you look at equity savings fund, most funds would limit 30-35% equity in the best case scenario. Conservative hybrid limited 25%. Balance give you 40 to 60. Dynamic gives you all things in between. Aggressive hybrid is one where minimum allocation becomes 65 in equity and max can be in 80. So this 15% gap is where the fund manager plays to create outperformance over mostly equity funds in the long run, is how most fund managers will operate this category as. But by definition, when you are committing 65 to 80% of your money into equities, that means it's a long-term product. It's not a medium-term product. It's not a short-term product. It's definitely a long-term kind of product that you're looking to invest in. And they actually tend to give you equity kind of returns over a decade or so, if you look at 10-year rolling returns, 7-year rolling returns or beyond, you typically see most of these funds actually come very close to equity funds in terms of return profile. But on the risk profile, they basically are better off. Why? Because at any point of time, you typically have about 20-25% cushion in the form of debt. So when the equity markets tank by like 20%, by definition, minimum 25% of your money is protected. That means you'll probably, if the market is falling by 20%, you might fall by 15. If the market is falling by 50%, these funds might fall by maybe about like 30% or so. So they basically give you cushion all the time. And the best advantage about these funds is if you are somebody who's an asset allocator and putting about 70% equity, rest balance in debt, these funds tend to auto rebalance your money all the time. So basically you put in money, if the market has gone up, the fund manager will book profit to the tune that the equity allocation comes back to 75, 80, as most fund managers prefer that kind of rule. So you're automatic rebalancing all the time. You have the advantage of equity taxation into these funds, and of course long-term alpha towards equity than towards debt. So these are good long-term products, and I would actually look at them as a replacement of equity for many people who are not super aggressive in their investments but want to have some kind of cushion in their portfolio all the time.
The question is then, Santosh, with regard to this, because this seems like a good solution for a lot of people to consider. Is it something that is consistent though, or is there a lot of switching out between the leaders in this segment?
So glad you brought that point up, Alex. Actually, the fund performance in this category has been quite erratic. Most of the in any year, typically top performers keep changing. While long-term returns actually are attractive compared to a debt or a balance advantage and tend towards equity, what happens is there is no fixed fund management style that each fund manager is having. Most people try to run a large and mid-cap strategy. Some people do only large cap strategies. Some fund managers run a flexi cap strategy for the equity component. When it comes to debt component, some people might be preferring an accrual strategy where they keep their monies in towards short-term dated papers, no credit risk kind of thing, and keep accruing some small amount of interest income on the remaining part of debt. But some fund managers may run a very dynamic approach to debt management. So that's where the fund management calls sometimes might go wrong, sometimes might go right. And of course, because 65 to 80% of the money is in equities, as we've been seeing over last many years, the outperformance or the sustained beating of performance by active fund managers is actually not happening in the marketplace. So 80% of large cap funds underperform the benchmark. Almost 50-60% of mid cap funds underperform the benchmark. So this underperformance outcome, of course, is visible in the equity component of the aggressive hybrid funds as well. Hence, you would probably see the winners keep changing every year. And hence, sometimes you might be better off as an investor that you want to have your own asset allocation and manage the equity debt component. You would not go wrong, at least in terms of running that strategy, whereas you might go wrong in picking a good fund manager who may be outperforming every year.
Thank you so much, Santosh, for making all of those points very clearly. And we've had a very fruitful conversation. I'm sure that a lot of people will have a few questions which we can address down the line as well. Thank you so much, Santosh, for taking
Sure, Alex. Thank you.